Hello, this is Dr. Karen Nunez. Welcome to the Chapter 23 lecture. In Chapter 23, we're looking at evaluating variances from standard costs. This is really an extension of Chapter 22. In Chapter 22, we looked at budgeting, establishing budgets so that we can determine whether or not we have met our goals and as a control aspect. So in this chapter, we're going to extend by using the standards that are used to develop our budgets as performance goals. Most companies use a standard cost for each of the following product costs: for the direct materials, for the direct labor, and for the factory overhead. Those are the key manufacturing cost components. And each one of those costs contains what we call a standard cost. And accounting systems are designed so that they use these standard costs for their products, and they're called standard cost systems. That means essentially that as we flow through the costs for materials, labor, and overhead, the costs that are flowing through the accounts are the standard costs, which means, of course, at some point we need to measure those standard costs versus the actual costs. Well, that's what we will ultimately do. But let's talk more about a standard cost. So the master budget, again, is developed using these standards, and then those standards are used to measure against our actual performance. So let's go back to this example that we've seen before, the Western Rider Company. They manufacture blue jeans, and we're assuming here that they use standard costs. They use a standard cost for direct materials, for direct labor, and for factory overhead. And the standard cost per unit is computed in this way. Every standard cost, whether it's for materials, labor, or for overhead, has two components. It has a price standard, that's how much it should cost, and a standard quantity, that's how much you need of that input. So, for example, if we're looking at the standard cost of direct materials, then the standard cost would tell us the price of the direct materials and the amount of direct materials that we need for 1 unit of product. Same thing for direct labor. If we're looking at the standard cost of direct labor, the standard cost will tell us the standard price of that labor or the wage rate per hour, and the standard quantity or the number of direct labor hours that we need for that product. So that's what a standard cost is. Again, it has two components, a standard price and a standard quantity. And this is an example. So for these jeans, this is their product, the cost object that we're looking at. And if we focus just first on the direct materials, the standard cost for the direct materials is $7.50 per pair of extra large jeans. And it has these two components that I just identified. The standard price of the direct materials is $5 per square yard, and the standard quantity per pair of jeans is 1.5 square yards. So again, what does that tell us? Well, it tells us for every pair of extra large jeans, they need 1.5 square yards to make a pair of extra large jeans, and the materials cost $5 per square yard. So when you put these two components together, $5 per square yard times 1.5 square yards, you get this standard cost for the materials. $7.50 is the cost for the materials. And we do the same thing for labor. So one pair of extra large jeans takes exactly 0.8 hours per pair, and the labor costs $9 per hour. So again, put these two components together, and we've got the standard labor cost for a pair of extra large jeans, $7.20. Let's move on and talk about variances. So whenever we measure something with a standard, uh, at some point, we need to compare that standard, which essentially tells us what we think it should cost, what we expect it to cost. We need to compare it with what it actually cost. And whenever you compare a standard with an actual, if there's a difference, that difference is called a variance. And in this chapter, that's our focus, cost variances, the differences between the actual cost and the standard cost. Now, whenever that variance is favorable, that means it has a positive impact on our profits. And that's going to occur when the actual cost is less than the standard cost. So whenever that actual cost is less than the standard cost, it's a favorable variance. And again, it has a positive impact on our profits. But on the other hand, we could also have unfavorable cost variances. That's when the actual cost exceeds or is greater than the standard cost. That's this. So we could have, a favorable variance, positive impact on our profit. We could have an unfavorable variance. That's a negative impact on our profit. And again, that's going to occur whenever the actual cost is greater than the standard cost. So we need to measure the differences between what we thought was going to happen, the standard, and what actually happened, and identify those variances. And we will typically do that on something that we call a budget performance report that summarizes all the actual costs, the standard costs, and those differences or the variances. So this is an example of a budget performance report. Again, if we focus on the direct materials, you can see we have actual costs of $40,150. The standard cost, though, to make 5,000 pairs of jeans is only $37,500. So the actual cost is greater than the standard cost. It cost us more than it should have. So what we have is an unfavorable variance, right? This is an unfavorable variance. The actual cost is greater than the standard cost. It's greater than what we thought it would cost. So it is unfavorable. Same thing with the direct labor. The direct labor actually costs more than the standard cost. It costs more than we thought it would cost, hence we have an unfavorable variance. And then lastly, when we look at the factory overhead, well, the factory overhead is actually less. The actual cost is actually less than the standard cost. So we have a favorable variance. And notice that unfavorable variances are positive numbers and favorable variances are negative numbers. And when you summarize with a total, you have to net the positives and the negatives. So in this case, 2,650 plus 2,500 minus 1,600 equals the 3,550. So every cost variance that we're going to look at in this chapter, the materials cost variance, the labor cost variance, and the factory overhead cost variance, we're going to divide into two components. So when we talk about the direct materials cost variance, the two components are, well, a price variance and a quantity variance. That means that when we have a variance that relates to the materials, it is either because it's related to the price. We spent more or less in terms of the price for the materials. That's what a price variance tells us. A quantity variance tells us that we either used more or less than we should have. And the same is true of the direct labor cost variance. A labor rate variance tells us that we paid too much or less than we anticipated for the labor rate. And the labor time variance tells us that we worked more than we should have or less than we should have. And for the overhead, well, we're going to take the overhead and we're going to focus on the components from the aspect of cost behavior. We're going to look at variable overhead and we're going to look at fixed overhead. So we're going to look at the overhead a little bit differently. Let's focus first. We'll come back and we'll talk about overhead in a few minutes. Let's talk first about the direct materials variance. So again, to summarize what I just emphasized on the previous slide, the actual cost of the materials was the $40,150. The standard cost of the materials was only $37,500. So we actually spent more on the materials than we should have, which means we have a cost variance that is, in this case, unfavorable. It is unfavorable because we spent too much. We spent too much on the direct materials. The actual cost exceeds the standard cost. And that actual cost, again, has two components. In this case, they actually bought 7,300 square yards at a cost of $550 per square yard. That's the actual cost of $40,150. But what they should have used was 7,500 square yards at $5 per square yard. These are the standards. The standard price times the standard quantity is the standard cost. That's what they should have spent on the materials, but they spent too much, hence an unfavorable direct materials cost variance. And when we analyze this variance on a performance report, this is what we're going to focus on. We want to be able to identify these two variances, a direct materials price variance and a direct materials quantity variance. I like this representation of the variance analysis. Let's start on the far left. On the far left, we have the actual cost. The actual cost is two things. It's the actual quantity times the actual price. They actually purchased 7,300, purchased and used 7,300. And the actual cost of the materials purchased and used is $550. So the total actual cost is that $40,150. In order to calculate a price variance, well, we're going to focus on the standard price. What should they have paid for that actual quantity? So this is the actual quantity at the standard price. So we're comparing the actual quantity at the actual price to the actual quantity at the standard price. The only difference is in the price. This is the standard price. This is the actual price. So that allows us to isolate what we call a price variance. So when we take the difference, 40,150 minus 36.5, 40,150 minus 36.5, we get this direct materials price variance. And it is unfavorable. Why? Because we paid $5.50 versus what we should have paid, $5. We paid 50 cents more than we should have. Hence, we have an unfavorable direct materials price variance. Now, to calculate the direct materials quantity variance, our focus is on the quantity. Now, the quantity here is the actual quantity at the standard price. This is what we purchased and used, 7,300. This is the standard price. But what we should have used, the standard quantity of materials is 7,500. And the standard price is $5. So we're holding the price constant, 5 here, 5 here. And the difference is the quantity. This is what we should have used. This is what we actually used. We used less than the standard, hence a favorable variance. So when we use less than the standard allows, it's a favorable variance. That's what we see here. 36,500 minus 37,500 gives us a favorable quantity variance of 1,000. So we've got an unfavorable price variance because the materials cost too much. We have a favorable quantity variance because we use less than the standard allows. And when we net these two, this unfavorable variance of 3650 minus this favorable variance of 1,000, the total direct materials cost variance is 2650 unfavorable. Again, 3650 minus 1,000 gives us the 2650, or we could also just look at the total numbers. 40,150 minus 37,500 gives us 2650 unfavorable. The actual cost here is greater than the standard cost. 2650 is the unfavorable direct materials cost variance. So every time we have direct materials, what we want to do to analyze the performance is focus on the actual cost here on the far left, the standard cost on the far right, actual quantity, actual price, standard quantity, standard price. And in the middle, it's the actual quantity at the standard price. That allows us to get a price variance here and a quantity variance here. And that's how we analyze the direct materials. And we do pretty much the same thing for the direct labor, right? So when we analyze direct labor, we want to compare the actual cost to the standard cost. So we actually spent 38,500 on that labor. The standard cost of the labor, though, is only 36,000. We spent too much. We have an unfavorable direct labor cost variance. It's 2,500 unfavorable. We spent 2,500 more than we should have on the direct labor. And the way we get these numbers, again, the actual direct labor is the actual rate times the actual time. Actual rate times the actual time. That's 38,500. And the standard cost of that labor, well, it's what we should have paid, the standard of 9 times the number of hours we should have worked, 4,000. So the standard cost is only 36,000. Spent too much. Spent 38.5, should have only spent 36. Now let's analyze so that we can determine those variances. So the same graphical approach here, the same model that we use for materials, we use for labor. The headings are just a little bit different. This is actual hours times the actual rate. 38,500 is what that labor actually costs. What should it have cost though? Well, if they work 3,850 hours, the standard rate is only $9. They paid too much. They paid $10 an hour. The standard is only $9 an hour. Hence, we have an unfavorable labor rate variance. 38,500 minus 34,650 gives us this unfavorable labor rate variance. The labor was too expensive. It cost $1 more an hour than it should have. And the time variance? Well, so the actual hours at the standard rate is the 34,650, but given their output, they should have worked 4,000 hours at $9 an hour. This is what the labor should have cost. It should have cost 36,000, but it only cost 34,650. So we have a favorable time variance. They worked fewer hours than the standard allows for that output. So given the output, they should have worked 4,000 hours, but instead they worked 38,050. They worked 3,850 hours. They worked fewer hours, hence a favorable time variance. 34,650 minus 36,000 is a favorable variance of 1,350. Put it all together, put these two pieces together, you have this unfavorable variance, and this favorable variance results in a net unfavorable variance. 38.5 minus 36 gives us an unfavorable direct labor cost variance of 2,500. So we're focusing on the same concept that we use for the materials. Actual at actual here, standard at standard here, and in the middle, actual at standard. Hence, we get a rate variance and we get a time variance. Put it all together, we have a total cost variance. And then when we talk about overhead, so we have the same model for materials and for labor, but we analyze factory overhead a little bit differently. And the reason why we analyze the factory overhead a little bit differently is because it's a mixed cost. Direct materials is a variable cost. Direct labor is a variable cost. But factory overhead has a fixed component. It is a variable component. It's a mixed cost. We can't analyze it in the same way because it behaves differently. So in order to be able to analyze the factory overhead, we need to divide it or separate it into the two components. So that's how we have to analyze factory overhead. We need to separate it into a fixed component and into a variable component, and then analyze each one separately. And the only one that we're going to look at in this chapter is the variable component. That's our focus here, the variable factory overhead controllable variance. And the model looks a little bit different than it does for materials and labor. We're going to focus on comparing the actual variable overhead to the budgeted variable overhead. And we call that variance or that difference the controllable variance. It's the variable factory overhead controllable variance. When the actual is less than the budgeted, it's favorable. When the actual is greater than the budgeted, well, it's going to be unfavorable. That's all we're going to do. So the example that I have for you here, we have the budgeted overhead. It's the standard hours at that standard rate. It's 14,400. That's our budgeted overhead, 14,400. And the two components of the overhead are listed here. The actual, that's what they actually spent. That's the variable component that they actually spent. That's the fixed component. That's total overhead. But again, our focus here is going to be on that variable component. We want to compare the actual variable overhead of 10,400 with the budgeted variable overhead of 14,400. And the difference between the two is just our variance. So what's happening here is they actually spent 10,400, but the budget is 14,004. They spent less than the budget. It's favorable. Favorable variances are negative. That's how we're going to analyze that variable factory overhead. So we have one basic model that we use for direct materials, and we modified slightly for direct labor. And then we have an entirely different model that we use for the variable overhead. That's it for the chapter 23 lecture. I'll see you in the problem solving session.